Looking for the next move in markets and wondering what falling oil means for your portfolio? Here's why a quieter crude tape and a busy central bank week could reset risk. Global stocks have inched higher as oil slips from recent peaks. That eases one of the biggest recent headwinds to risk assets. Cheaper crude lightens input costs for manufacturers and shippers. It also takes pressure off headline inflation, which had been sticky after oil's run-up. This shift lands just as the Fed, the ECB, the Bank of England, and the Bank of Japan line up with fresh guidance. Markets are pivoting from parsing each data print to decoding policy signals. The first insight? Easing oil can cool inflation expectations at the margin. A $10 swing in crude can shave roughly a quarter point from headline inflation over a year. That influences discount rates, front-end yields, and the appetite for longer-duration equities. Second, policy sensitivity is rising. With rates at multi-decade highs in the U.S., even small surprises can spark big moves across bonds, stocks, and FX. Investors are recalibrating how long restrictive settings will persist given mixed growth and price signals. Third, sector leadership may rotate. When energy prices retreat, commodity-linked shares can lose momentum. Rate-sensitive growth and quality names often regain footing as discount rate pressure eases, though earnings resilience still matters. Fourth, each central bank has a distinct lever. The Fed has held 5.25% to 5.50% since July 2023. The statement on inflation persistence, labor tightness, and balance sheet runoff could shape the entire curve. The ECB's 4.90% deposit rate meets weak growth but sticky services inflation. The BOE at 5.25% faces cooling wages that are uneven by sector. The BOJ, now near 0%, remains crucial for global liquidity through yield curve control and bond purchases. Finally, index math still counts. Energy is only about 4% to 5% of the S&P 500, but oil's direction can sway earnings and sentiment beyond that slice, especially in transport, chemicals, and industrials. What can you do now? Track front-end yields and policy language more than the headline rate. Stress test portfolios for a slower-than-hoped disinflation path. Balance exposure between quality growth and cyclicals, with an eye on cash flows under higher-for-longer rates. If you hold energy, separate short-term oil beta from long-term capital discipline. Want the deeper dive and the numbers behind these moves? Read the full article at finlitica.com. Quick reminder. This is general information, not financial advice. Your money, your decisions, so always do your own research.